Hey guys, welcome back to the channel and welcome back for another video. So in this video, quite a bit of y'all have been asking for a tutorial on the basics of options trading. You're interested in getting into options, but you're having a hard time understanding, the fundamentals of what options trading is. And so there are pros and cons to it, like anything else. But the reason people love options so much is because it allows you, unlike stocks is very straightforward. Mostly you buy low, sell high, unless you're shorting stock, but that's a whole nother thing. With options, you can profit if the stock goes up, if it goes down, if it trades sideways, if it doesn't move at all. There's so many different ways to make money with options, unlike, like I said, like stocks. So a lot of y'all that are interested want to get into options, but are having a hard time understanding the fundamentals, the Greeks, so on and so forth, because there is a lot to options. It's not something, like I said, like stocks, you can just get in and trade. There's risk involved, so on and so forth. But with anything, any kind of investment, there's risk. So what I want to do is I've created this to go step by step, and I want to keep it as simple as possible. I'm not going to go over strategies. It's just going to be the simple buying calls, buying puts, for those that are looking to get in, to options trading. And some of this might not make sense, but don't worry, I'm going to cover it on the platform, on the trading platform. It'll be more visual and it'll be easier to understand when I put it into context. So the first thing you could think of is, what are options? Well, options are simply financial instruments. It's a derivative, and they derive that value obviously from the underlying stock. And so a call option, it allows the holder to buy the asset at a stated price within a specific time frame. Put options, on the other hand, allow the holder to sell the asset at a stated price within a specific time frame. Now, to keep in mind that option contracts represent 100 shares of the underlying security. So if you buy one contract for Apple, it's almost like you're saying, I'm buying 100 shares of Apple, but a lot less capital, which is another advantage and something that people love about options, because it requires much less capital, especially if you're just starting out with a small account. And again, that premium that you pay is the price of the contract. So as I said here, for example, if the option has a premium of $1, since it's 100 shares, you multiply that $1 by 100 shares, and it's $100 is what it would cost you for that contract. Now, the thing about options, stocks, you have an infinite amount of time. Basically, the only way you lose your entire investment is if the company you're invested in goes bankrupt. With options, not only do you have to be right about the direction of the stock, you also have to be right within a specified amount of time, which is known as the expiration date. And that's what makes it a little more challenging. But there are ways to mitigate that and make it easier to not have time work against you. And like I said, with various strategies, there's so much that goes into options. But like I said, for this video, I want to keep it basic. So what you have to focus on is you pick a stock, you determine, you think it's going to go up or do you think it's going to come down, and in the amount of time you think that move is going to happen. And that's what you have to focus on with just buying call options and buying put options. Now again, like I said, buying call options, it gives you as the buyer the right but not the obligation to buy a stock at a specified price within a specific time period. And when you buy call options, it means you're bullish, which means you are in favor of the stock going higher. You believe the stock's going to go up in price. So if the stock goes up in price, the value of the contract that you hold, or contracts, go up in price as well. And they should. And there's a reason I underline should, and I will cover that later in the video. Now, buying put options is the opposite. It gives the owner the right but not the obligation to sell or sell short a specified amount of the underlying security at a predetermined price within a specified time frame. So the parameters are similar, but again, this is you have a bearish view on the stock, meaning you expect the stock to decrease in price. So as the stock comes down in price, the value of your put option contract will actually increase because you're betting for the stock to come down. It's coming down, so therefore you're making money. So what are some of the fundamentals of options trading? Well, as I mentioned earlier, strike price is one thing. And like I said, I'll cover that more in depth in a bit when we go onto the platform and explain to you exactly what that is. So it's important that you pick a strike price, an expiration date of how fast or how long do you think it's going to take for that move to materialize that you're predicting. If you think the stock's going to, let's assume you think Apple's going to go from $150 to $160. Okay, now the expiration date, you got to choose how fast you think that's going to happen. A month, 6 months, a year? That's up to you. Now, of course, the longer, the more time you give yourself, it's like insurance. The more time you give yourself, the more expensive the contract is going to cost you. So a contract that expires next month might cost you $300, but a contract that expires a year from now might cost you $2,000. So you're paying a price for, I guess you could say, a lower risk in a sense, but actually you're buying time is what you're doing. So that's another thing you have to factor in when you come to options trading. The bid-ask spread, which is very important. That's the difference between the highest price that a buyer is willing to pay for an asset and the lowest price that a seller is willing to accept. So when we get into the platform, the narrower the bid-ask spread is, the better. So let's assume you're trying to sell something for $5, but no one wants to buy it from you. The most they want to buy it for is $4.50. Well, you're going to have to meet somewhere in the middle and negotiate and be willing to sell it for $4.75, and they're going to have to be willing to buy it at $4.75 so you can sell your contract, take your profit, and then someone else can obviously own it. Now there's three different kinds of three decisions you need to make when you choose a contract. Now, are you going to buy a contract that's in the money, which is an option strike price, which is below the current market price of the stock? So if the stock is trading at $100, a strike price of $99, $98, $97, $80, $50, that's in the money. At the money is a strike price that is nearly identical to the current stock price. So if there's a stock that's $100 again, $100 strike price is at the money. Out of the money is something of an option strike price that is above the current market price of the underlying security. So the stock is $100, a strike price of $105, $110, $115, that's out of the money. So there is risk involved, and there's a reason why you have to be very careful which strike price you choose, and I'll go over that in a bit as well. Now the Greeks. This is where a lot of people have trouble understanding what the Greeks are, because this is really what makes up an options contract. Okay, so you have the delta, the theta, the gamma, and the vega. The delta measures how much an options price is expected to change per $1 change in the price of the underlying security. So if you have a delta of 50, for every dollar that stock goes up, you're basically profiting $50. But for every dollar that stock comes down, you're losing $50. But that delta does change over time. Again, I will go over that with you in a bit when we get to the trading platform. Theta is basically your enemy when you're buying options. That is the one thing you don't want to be a part of, is you have to understand that theta is time decay. As your options, as days go by, your options lose value. Whether it's 1 cent or 50 cents, they lose value. And there's a way to lower the theta so that your options do not lose as much value from day to day, instead of them losing chunks and chunks. And as the expiration day gets closer and closer, within the last 30 days, theta does accelerate. So it's always best to close your options at least 30 days before expiration, because theta does accelerate, and then you start seeing that your stock price is going up, but your option price is really not moving, and it's because theta is consuming the value of your call option. Gamma is the measure of the rate of change of its delta. So gamma just tells you for every dollar the stock goes up, delta is going to move from 50 to 51, the size of the delta. And vega, and the reason vega is important is because it measures the option sensitivity to implied volatility. So implied volatility is a market's forecast of the movement they believe so as a market as a whole, earnings are coming up, and investors believe Apple's going to have a great quarter. Implied volatility is going to spike because people are anticipating a big event occurring, a big news event, something, and it just doesn't have to be earnings. It could be any kind of speculation. As soon as that news is announced, and you may have heard the buy the rumor, sell the news, that is a common theme in the market. But as soon as the news comes, the implied volatility will shrink, and that'll actually decrease the value of your option, even though the stock continues to go up, and that's known as IB crush. So an easy way to look at it is, let's assume that, again, there's a stock that's trading at $100. You have a contract and the earnings come out and the stock goes from 100 to 110, your value of the contract, you could actually lose money even though the stock went up. And of course you're thinking, how is this possible? How am I losing money when I picked the right direction? I anticipated the stock was going to increase, which it did, and it increased by $10, but yet I'm losing money. This makes no sense. And the reason is because implied volatility is crushed. It's basically like demand. No one wants the contract anymore. The event happened, it's over with, and the extrinsic value of that contract just declined sharply. So it is very possible. My way of getting around that, I do not trade options around earnings. So if I have an option and earnings are coming up, I will sell it before earnings. It's that simple. I do not hold through earnings at all, because it's a huge risk. Earnings in general are a gamble, because you don't know how the market's going to react to earnings. The earnings can be great, and the market, the stock could sell off. So I never trade. I can trade up to earnings, but I will never hold a contract either the day of earnings, or if it's after hours, I definitely sell during that day or possibly sooner. But I will never hold an options contract through earnings. So with that being said, I'm going to go over to the Webull trading platform. We're going to go over all this again and I'm going to walk you through what it's like to buy an option contract, just the components that make up the process of purchasing an option. And we'll start with a call option, and the put option is the same thing, just in the opposite. But we'll do that right now. Okay, so I'm here on the Webull trading platform, and I'm just going to use Apple as an example. So let's assume you're looking at Apple here, and right now it's trading at 149, and you think it's going to get to 155. Okay, so however you've decided this, whether it's technical analysis, fundamental analysis, you believe Apple is going to go to 155, or you think it's just going to go higher in general. Okay, so you want to buy a call option. Okay, you're bullish. So a call option is when you buy an option because you believe the stock is going to go up. So now you got to ask yourself, how fast do I think Apple will get to 155? Is it going to take a couple weeks, couple months? Most people, for whatever reason, love buying contracts that expire within a week or two. Me personally, the minimum, the shortest amount of time is 3 months. Anything 6 months or more, to me, is better. Yes, you do pay more because you're buying time, but I'd rather be safe and give it time to materialize. But if you have a certain strategy, if you're setting stop losses, then 3 months is perfect. I've done 3 months plenty of times, but because I have a plan, I have a strategy of how I'm going to get in and how I'm going to get out. So, but if you're looking at holding this for a while, the best thing is 3 months is the minimum. I'd go 6 months or more, especially when you're starting. The further, the more time you give yourself, the better, because there are going to be times where something goes completely against you. And obviously you have two choices: cut your losses, or you wait it out. But again, it's no guarantee it's going to recover. So for this example, let's assume we're going to go at least to November. Okay. So now we're here in the November expiration date. And you think the stock is going to go, like I said, to 155. Okay. The strike price is basically what's important about the strike price. If you look at the prices here, okay, look at the mid price. You're going to multiply this times 100. So really this contract right here is costing you $995. This one's costing you $1,300, $1,700, $2,100, $2,500. As you can see, the deeper in the money you go, the more expensive it is. And the reason for that is because it is more of a safer bet to an extent. And the other thing you have to pay attention to is the break-even point. And the break-even point is simply the strike price plus the cost of the contract. So, or the premium, you could say, which is the same thing. Okay. But again, the deeper in the money, the safer it is, and the bigger the delta, as you can see, but it's going to cost you a lot more. The further out of the money you go, the riskier it is, the smaller the delta, but the cheaper it is. As you can see, it's only $162 for this contract. Okay. Now, my rule is simple. I always pick, if I'm going to go out of the money, it's probably just going to be one tier down, which is about $5 off. It's nothing. It's either, like, if I'm choosing this contract right now, I'm picking 145 or 150. That's basically what I'm picking. I always try to pick something with a delta around 50 at the minimum. Now, the thing, like I said, about the delta is you have to keep in mind that if you were to purchase this contract right here, it's 100 at the 150 strike, it's going to cost you $725. This is the bid-ask spread that I was explaining earlier. Okay, the buyers are willing to buy this contract for $7.20 or $720, but the sellers are willing to sell it at $730. So there's a there's no agreement here. So if you want to get filled immediately, you're going to have to pay somewhere in the middle, and which would be the $725, hence why it's a mid price. So you can put in your order for $720. Doesn't guarantee you're going to get filled, but if you want to get filled immediately, more than likely you're going to have to go up a few cents and pay the mid price. So that's why it's important to have a narrow bid-ask spread. You don't want something that's going to have, a $2, $3 bid-ask spread, because you're gonna end up paying a lot more than you should for a contract, and then when you try to sell it, you're gonna have a hard time selling it, and you might have to basically sell it for less profit than you should be getting, because no one wants to buy it, because there's a huge discrepancy between the bid-ask and the bid-ask spread is just too wide. So always try to go for me personally, 50 cents or less is what I go, and that 50 cents is a lot into my, from what I've experienced. So I always try to go less than 50 cents when you are purchasing the contract, the liquidity. And the way you can also look at that is open interest and volume. Open interest, which is this column right here, is telling you how many of these contracts are currently open right now, which are 36,000. That's plenty. And the volume, this is the amount of contracts per this day. This 150 strike, 2,745 contracts were traded, and that's a lot, And of course, this is Apple. But if I were to go to, let's just say, Exxon, you're going to see the numbers are going to be different for whatever they are. See, you have 2,200. So you can see up here, nobody's trading these. So for every stock you look at, the numbers are going to be entirely different. And some of them, it's not even worth getting an option. You might as well just buy the stock outright because the liquidity is horrible. So that's why with this example, I'm sticking to Apple, because it's something that is very fluid. So again, when we go back to this, we look at the original thesis that you have is that Apple is going to get to $155. So you're looking around this range. And you say, okay, you know what? I'm going to give myself 3 months of time for that to happen. So, you go out to November. You can go out even further. But let's say you want to be on the really safe side, and you go out to January of 2023, which is called basically a leap option. And leap options are that. It's basically 6 months or more of a contract. It's just a term used. It's basically saying that you're using this for a long term. This is a trade, but it's almost an investment to an extent. But as you can see, the prices are $2,000, give or take, to $2,000, $2,200 is what you're going to pay for this contract. Now, it is a lot more than paying $700, but you're giving yourself basically another 15 months or so. So those are the options you have to weigh. Do you want to pay more up front to buy time, or are you so sure that this is going to happen really quick that you only need 3 months? The good thing about options is upfront how much you're going to lose. Okay, so going back to this example of November, I know if I buy this contract right here for $500, $510 is the most I'm losing, no matter what happens. If the stock goes to zero, if Apple files bankruptcy, $510 is the most I'm losing, and that's it. Okay, so like I said, a lot of people love these down here, which is $100, but again, I'll give you an example of why or what happens if you buy these. Okay, let's assume you buy this one for $162, okay, which is the mid price. You get filled, you have the option. The delta is only 19. That means that for every dollar that Apple goes up, you're making $19. So if it goes up to that 155 you're looking at, it's about a $6 move or $5-6 move, you're making $100, give or take, is what you're making. Now the delta will increase as the stock increases, but it's not going to shoot up from 90 to 50. It might go from 19 to 50. It might go from 19 to maybe 22, 23. So as the stock keeps going up, for every dollar you're making a little bit more. However, if for whatever reason you're looking at Apple, and Apple decides that some terrible news comes out, and Apple goes from 149 all the way down to, let's just say it goes down to the 200-day moving average here. It goes from 149 to 128. This contract that you're holding right here, this delta of a 19 might end up being 8 or 9. which means that for every dollar now, you're only making $8 or $9. So if you want to do the math, let's just say it's $19 and the stock drops $10. You're down $190. But now with the delta being basically cut in half, it's going to take you more than a $10 move just to break even. Because now when it's coming up, it's moving at a pace of $9 for every dollar it's going up. I hope that makes sense. So initially, you're making $19 on this for every dollar Apple goes up. But you're losing $19 for every dollar Apple comes down. This delta will move up or down. It'll increase if the stock goes up, but it'll also decrease if the stock comes down. I guess the advantage to that is that your losses will decelerate. The acceleration, the speed at which the delta, or that you're losing money, will slow down, because that delta is just going to start getting smaller and smaller and smaller and smaller. So your delta of 19 will end up being a delta of 8, and now for you to recover, you're going to need more than a $10 move just to probably break even, like I said. On the other hand, if you buy this call option, and let's just say Apple takes off from 149 to 170, your delta might move from, say, 19 to 36 to 40. Who knows? It just keeps going up. Yeah, you're making a ton of, your return on investment is going to be well over 100%. So those are the pros and cons, like I said, to choosing strike prices. For me, the safe bet is always, I prefer. And then, like I said, trading is not a one-size-fits-all strategy. You have to find what's best for you, what fits your personality. So I prefer to pick something that's in the money or out of the money slightly. And I know that if I buy this contract, the most I'm losing is $725. I can live with that. But like I said, I have a trading plan where I will cut my losses once I see things that are not going my way. So I won't lose the whole 700. Maybe when I'm down 200, I'm out. But that's, something that comes with time and understanding when do I cut losses and when do I just let it run. So now if you're buying puts, it's the same concept, except the delta is negative. And the reason is because you're betting for the stock to come down. But the principle is the exact same thing. As the stock starts coming down, you're making money. So if you pick this 150 strike, for every dollar that Apple comes down, you're making $50. Now for every dollar Apple goes up, you're losing $50, because your thesis is that Apple is going to decrease in price, but it's actually increasing. So I hope this makes sense. I know there's a lot of moving parts. There's a lot of components when it comes to options. But I think the most important part is just understanding. One is risk. Risk management is number one. No matter what you do, whether it's stock, whether it's options, whether it's cryptocurrency, no matter what kind of investment, risk management is the number one thing you got to focus on. Okay. So don't come in here buying 10 contracts of this $800 and now all of a sudden you're in Apple and you have $8,000 here and it starts going down. And because for every contract, if I'm looking at the calls, keep in mind that for every contract you hold, the delta is 50. So if I have 10 contracts, you're multiplying 50 times 10. That means for every dollar the stock goes up, you're making 500. But for every dollar it goes down, you're losing 500. So of course you think, well, if I just buy 10 contracts, it goes up $1, I make $500. Yeah, you're right. You're right. You're gonna make roughly $500. But what if it comes down $2 and now you're down 1,000? You also have. It's not so much thinking about how much money I can make. Just think about how much money you can lose. And if it doesn't work out and you just keep holding and keep holding, you bought 10 contracts at $700, you're going to lose $7,000, probably close to $7,500 more or less. But that's why it's important to have a trading plan and understand, like, let's just say I'm going to buy this right now. And this is part of my trading strategy. I look at this. I look at support and resistance. Resistance looks like it could be 150. Support could be like right here with the 50-day moving average is 141. If I buy contracts and Apple comes down and breaks this line right here and goes under, I'm out. I'm not holding. I'm not waiting till expiration. I'm just getting out, But that's my trading plan. So if you're comfortable with buying a $300 contract and just, hey, if it doesn't go my way, I'll lose $350. I can live with that. Fine. Hold till expiration. See what happens. You never know. It could turn around. But again, when you're first starting out, start off small. Don't try to. It's not going to happen. As far as getting rich quick, and it's not. If you really want to learn this, it's going to take time. And I try to. I'm hoping I'm as clear as possible, trying to be at least. But I do know that options are. It's almost like learning another language to an extent, especially with the Greeks. But the most important thing, like I said, is you look at the PowerPoint, and the first thing you got to decide is, which stock do I want to get into, and ask yourself why. Don't just, oh, well, I saw it on Facebook or I saw it on YouTube that this is a great stock to get. No, you have to have a reason, Like I said, if I was getting into Apple, there'd be a reason, whether it's the chart or whether it's fundamental analysis, or there's a reason that I think that this stock is going to go up. And once you make the decision on the stock, now you got to decide how high or how low do I think it's going to go. And after you decide that, then you have to decide in what amount of time is that move going to materialize. So again, the further out you go, the more time you give yourself, but the more you're going to have to pay for it. I mean, you're going out all the way to September of the year 2023. You're paying basically close to $3,000 for a contract versus November, where you're paying $700 to $1,000. There's a big difference there, but there's a lot more time. So, and here's the thing, as I mentioned earlier, that some people love these close to expiration. I mean, if you're going to do it for a day trade, that's one thing. But if you're just trying to start out in options, day trading is not the way to go. Not at the start. But let's just use this. Let me just show you this as an example. This expired today, this contract, okay? Keep in mind that, one, you do not have to hold contracts till expiration, okay? You can close them way ahead of time and take the profit. So if you get in a contract on Monday and Tuesday or Wednesday that stock goes up and you make the profit, you're happy with it, close it. Just close the contract, get out, and take your profit. You move on. You don't need to hold it for the entire time. And I don't encourage you to do that, because theta, like I said, time decay will eat at your profit and eat at your contract. So as I said before, looking at this November, you can see here that it's roughly so look at this one, $50 for every dollar that it goes up or down is what you're making or losing on this one. And the theta, you're losing about, if you look at the 0.04, you could say 0.04 and 0.50. Okay, there's a big discrepancy there. Okay, but now let's go over here to the one that expired today and look at the discrepancy here. It ain't much. You see what I'm saying? You can look at it in a way, if you want to look at this November, I'm losing $4 every day that the stock just stays where it's at. If the stock does not move, I'm losing $4 every day. Look at it that way. Here, I'm losing $44 every day that the stock doesn't do anything. So there's a huge difference. Why? Because this is expired today. This expires in November. And if I go further out all the way to that September, you can see that here you're losing almost like a dollar. Maybe $1.70, give or take, but like $1 is what you'll be losing. So there's a huge difference. That's why time decay, when you're buying calls and puts, is your enemy. Now, when you're selling calls and puts, it's a different story. But like I said, that there's so many strategies, and I'm not going to discuss that here because it just gets more confusing. And it's important that you learn the basics before you try, selling calls, selling puts, and doing iron condors and straddles and strangles and put spreads or credit spreads and debit spreads. There's a lot of strategies out there, and like I said, but the basics is first learning how to buy calls, buy puts, what's behind it, because these are very straightforward. It's just like stock in a sense, but of course there are other things you have to, because it is a derivative. It's not, you buy the stock at $3, you sell it at $5, you made a $2 profit. There's more to it, because like I said, with the delta, the theta, implied volatility, so on and so forth. But this is the disadvantage that I would say stay away from anything that's less than 3 months, because this theta will eat at your contract and it'll be worthless, and you don't want that to happen. You don't want to be profitable and just want to squeeze out every penny hoping it goes up more, because as that day of expiration gets here, you're going to notice that, wait a minute, I had, let's just say, $1,000 in profit, and why do I now have $700? Well, because every day that you're holding that contract, it's losing money. And so the further out you go, like I said, this November one, you're losing $4 a day, but the one that expired today, you're losing $45 a day. The one that expires next week, you're losing $15 a day. Now look at that, in 1 week. Next week's contract right now is losing $15 a day. Look how fast that will accelerate. By next week, it'll probably be in the $40 range a day. So hopefully, guys, this makes sense. I hope it's not confusing you even more. But like I said, for any reason, if you have any questions, drop them in the comment section. I will be making more of these videos. If there's anything y'all want to see, let me know. Like I said, there's just so much to options, but the basics are what I covered. Understanding. At first, you're going to feel lost. You're going to look at, you're seeing numbers all over the place. What are derivatives? And well, what if I buy here, sell here, and wait a minute, why is it not like the amount like a stock? No, because it's a derivative. And why am I losing money even though the stock is going up because of the IV crush? And there's a lot to learn, like I said. But if you have questions, drop them in the comments. I'll do my best to answer them, and I'll be making plenty of videos, like I said, that are going to cover strategies with options, different ways to buy them, sell them, when to buy, when to sell, stop losses, when to take profits, so on and so forth. But for this video, like I said, I just wanted to keep it simple. Hopefully this makes sense. But again, if you have any questions, drop them in the comment section. Don't forget to subscribe to my channel, hit the like button, and I will catch you on the next one.